Just going to give it a couple of minutes to see if we've got a few more attendees coming in. Maybe a second before we get started. All right, we better make a start so that we can get through everything that we've got in plan for you today. Welcome to Retirement Planning with Australian Catholic Super. My name is Bill Thompson. I'm a relationship manager out of our Brisbane office, currently at home and been in isolation for a week. So I'm looking forward to getting out from tomorrow, all things going well. And I'd also like to welcome Tina Tran, who is our financial advisor based in our Sydney office. Welcome along, Tina.
Thank you, Bill. Looking forward to sharing some information which will hopefully help our members with their retirement planning.
Definitely. So a few things we need to get through in the beginning. First and foremost, I would like to acknowledge the traditional custodians of the land on which I work and live. I'd like to recognise their continuing connection to land, water and community, and pay respects to elders past, present and emerging. Also, very, very important at the outset that we just let you know that any of the information that we discuss with you today is of a general advice nature only. Because we're not taking into consideration your personal circumstances, please make sure that you do your own research if there's any of our products that you'd like to take advantage of, and if it's appropriate, seek financial advice. Just be aware that Tina and I are both salaried staff members. We don't get any commissions or bonuses in our roles, so you can rest assured that we're working in your best interests. So we're going to go through our presentation today. I'd just like to invite anybody that has any questions as we go through to lodge those questions through the question and answer feature on the top of your screen. So if you can click on those, we'll make sure that we answer those progressively if we go through and they're relevant at the time, but we will certainly be around at the end of today's presentation to make sure that you get an answer. And just be aware that if you do ask a question, we'll pass those details on to your local relationship manager and they'll reach out within the next couple of days just to make sure that you get everything that you need. And if there's any other questions that you might have, they'll definitely be able to handle those for you as well. Another little disclaimer just on myself personally, I am multitasking today, so I'll be keeping an eye on the questions. So if I'm not looking at the screen or if I mess up, it's because I'm not very good at multitasking. Should have let you do it, Tina. Probably would have been better off. All right, just to kick off our presentation today. Retirement. I don't know how far most of us are away from it, but the importance of retirement and what that retirement looked like is very much going to depend upon what your retirement goals are. Okay, so we've got some examples in front of you in terms of what sorts of things people have been doing in retirement for a long period of time. And I think it's fair to say that as medications and medical science has improved, we're living longer, we're living healthier lifestyles. So we tend to be a little bit more active in our retirement than certainly my father and previous generations. But some of those retirement goals will depend on how much you need in retirement to live a comfortable lifestyle. We've got cruises on there. Tina, I'm not sure that's something that too many people are doing at the moment, but I do understand that they are starting to show a little bit more interest in going on cruises as we speak.
Certainly has been travel has been off the agenda for a lot of people, but it is coming back.
It is coming back, so we're allowed to get out and about a little bit more, but the types of travel that you do will depend on how much you need in retirement to support that travel. If you're comfortable just heading up the coast and doing a camping trip or living in the caravan park, you can imagine obviously that that's going to cost a lot less than if you have You know, all the bells and whistles. You're traveling overseas, you might want to go on a river cruise and see some very cool stuff over there. It's going to be a lot more expensive in that circumstance. So just be aware of that, and you can factor that into your planning as we go through. An excellent starting point is where you are right now. So how much you have in superannuation right now is an important factor. And of course, how long between now and when you're planning on retiring, and what you can do with your superannuation between now and then to make sure that you're in a very good position to sort of do that. So I'd encourage all of you, if you aren't already aware, to check on your balance and make sure that your contributions are coming through. It's all well and good that we trust our employers, Tina, but it's fair to say that there are some employers out there, not as many anymore, that probably aren't meeting their obligations. So part of your process should definitely be to make sure that the contributions that you're due are being received. Now, Tina, I'm going to get you to speak to this in a little bit more detail, but I know from my experience in going out, and we visit schools and we have a chat to our membership and others on site. One of the biggest questions I get asked, and I'm sure yourself, how much do people need in retirement? Let me ask you this question. Is it $1 million?
That is the magic number that seems to be floating around out there. And what we have been able to help members figure out is if they need that $1 million. And that is very much dependent upon whether retirement is at pension age or before pension age or much further down. And it's also dependent on how much each year you want to live on. And there are some average figures, and which is what this slide is about. So you can see on the first left column, there's the full age pension for a single and a couple per year. And then there's the ASFA, which is the Association of Superannuation Funds of Australia, modest figure for a single and a couple, and the ASFA comfortable for a single and a couple. And that's the amount that they've benchmarked would be an annual expenditure for having a modest or a comfortable lifestyle. What are some of the assumptions that go into that figure is that it is based on owning your own home, so you're not paying rent. But essentially what you are paying for is the cost of running, living in your home and running a car and food and some lifestyle. Now, there's a difference between the ASFA modest and the comfortable. Is that comfortable has a bigger component for lifestyle. And that's where we try to at least help our members to achieve a comfortable retirement. Now, that may not be comfortable for everyone. For some people, comfortable might be a bit more than that because they would like to be able to, for example, incorporate an overseas trip every year, whereas the ASFA comfortable bigger budgets for an overseas trip maybe every 2 or 3 years. The modest figure doesn't include overseas travel, maybe some domestic travel. So there's a little bit of difference there in regards to what that definition of a comfortable lifestyle is. And it's predominantly revolving around that lifestyle component, not so much about paying bills, because in essence, the full age pension should be enough just to cover the bills.
So one of the examples I know that ASFA has done, just to dispel that myth of $1 million being what you need to retire comfortably on, Tina, what sort of a balance would you need at retirement if you retire at pension age, which we'll call 67 at this point? What sort of a balance would you need at that point to support a comfortable lifestyle?
Yeah, so with ASFA, they've done some basic financial modelling, and the assumptions they have in that model is that the superannuation would be fully used up by the time the person's reached age 90, and the inflation rate is assumed at, I think, 2.5%, and the investment earnings rate at 6% applied to their superannuation. So using those numbers and applying the as per comfortable spend rate and incorporating age pension eligibility, a couple would need around $650,000. That's both of them having reached age pension age. So you don't need $1 million to be able to reach that as per comfortable, because you have age pension buffering in as your money runs down. And also you're retiring at pension age. Now, you will need that $1 million, of course, if you're wanting to retire before age pension age. So because you'll need to be self-funded for a fair bit of that time, the earlier you retire, and therefore the capital required is going to be a lot greater. For a single as per comfortable, I think it's about $550,000 per annum. And that amount can also be less if you phase into part-time work. So that could also help to reduce the amount of capital that you need in your superannuation to achieve that comfortable retirement.
Perfect, thank you. Now, I know the ASFA, the Association of Superannuation Funds Australia, have done that research, and if you're interested in having a look at their results, and this page is a part of that particular document, it gives you some practical examples of what that might mean for you in retirement to live those different lifestyles. So if you have a look on the left-hand side, and we're just kind of focusing on that comfortable lifestyle, one of the things that would be important to me at retirement age is being able to afford a decent level of health insurance. Being a type 1 diabetic, and given my family history, which is getting increasingly worse, health insurance is something that's very, very important to me. But certainly the types of holidays that you take, the type of travel that you do is going to be of interest to you there. Being able to leave the heating on or the air conditioning on, depending upon your weather and where you might be located, that's also an important consideration. But if you're interested in having a look at that document in greater detail, if you go to your search engine and you just type in the ASFA retirement standard, you'll be able to find their site and have a look into that in a lot more detail. But Tina, I suppose we all consider that superannuation is going to form probably the most significant part of our retirement plan, but it's certainly not the only part of the plan. And I think what I've enjoyed working with some of our financial planners is I've certainly learned a lot more information about the other pieces of the puzzle that you can fit into building on your financial situation.
We certainly try to help our members look at their goals in terms of retirement, and then take account of all the available assets and resources they have available. So we know age pension eligibility. Then we also take into account any existing savings that the member might have accumulated through saving for work, saving income into bank accounts, term deposits. Perhaps they've got some shares as a result of owning products in companies that have demutualized, or they've inherited some shares. It could also be that they've actively invested in rental property or inherited property. So all of that's going to be taken into account to look at the resources available, including superannuation. There's also some instances where members could consider their home as a potential retirement funding asset. And it may not be deliberate. It could be as a result of the house being very large, and as they're aging, they may want to go into a smaller, lower maintenance property, which may have less value than their existing home. And as a result, they've got surplus money that they could add to their retirement. Sometimes it is a deliberate strategy. Maybe they've not had enough saved up in superannuation, and in order to be able to afford a comfortable retirement, they've decided to relocate to a place that is cheaper and cash in on the equity in their home to add to their retirement funding. So we're going to explore all of those options, but it is based around trying to achieve at least the comfortable retirement income for their lifetime, or whatever amount it is that they have quantified to be comfortable.
If I had a crystal ball, I probably would have invested in fuel back in 2021 when it was a fair bit cheaper.
And farms, lettuce at the moment is apparently
Yes.
quite expensive.
Apparently, they can't even put it in McDonald's anymore. Okay, so we are obviously a superannuation fund, so that's our strength. That's our bread and butter. So there are definitely benefits to saving within superannuation, and tax being probably the number one part of that. Tina, what are the benefits of tax in superannuation opposed to, let's say, your marginal tax rate?
So superannuation is a low tax structure. What that means is that the investment earnings that are generated within your superannuation is taxed at a lower rate than it would be generally if you had the investment in your name and taxed at your marginal rate. Now, if you're still working full-time, most likely your marginal tax rate is going to be at least in the 32.5%. That means any investment earnings that you generate in investments that are held in your name, you'll be losing 32.5% of that earnings. Whereas in superannuation, you're not being taxed at that rate. The superannuation fund does pay tax on investment earnings up to 15%. So the fund generates more result in regards to less of that being leaked out in taxation, and that's going to equate to your superannuation growing at a faster rate. In addition, there's no capital gains tax at your marginal rate, which would occur if the investment was held in your name, you sell it, and you'd be up for capital gains tax if you're still working. That might be a different situation when you're retired. So again, that creates a opportunity for your money to grow at a faster rate. Now that's in the accumulation phase. In the middle phase, where we call the transition, that's still the same as it is in the accumulation. So again, it's still a low tax environment. And in the retirement phase, it's a tax-free environment. So you get to keep all the investment earnings and there's no leakage to tax. There really isn't any other simple structure that like that allows you to have money invested and tax-free investment earnings, as well as allowing you to have access to that money to withdraw as an income or as a lump sum without having to worry about tax.
Beautiful. So I suppose, well, one of the contribution methods that people are probably familiar with is salary sacrificing into their superannuation. And we mentioned a little bit about the lower tax elements that's applying to superannuation at 15%. If you use that example before, where somebody's earning and they're paying 32.5 cents in the dollar, you can see on this particular graph, Tina, that 32.5% is quite a bit more than the 15% that would apply if you took that money home with you on the day.
Certainly, this is you can see that if you start earning more than 18,200, you start losing 19 cents in the dollar for every dollar that's above that. And once you go above the 45,000, you're losing 32.5 cents in the dollar. Now, the salary sacrifice is where you redirect your salary instead of having it paid to you into your bank account and losing 32.5%. Going into super, you're only losing 15%. So that's a guaranteed result in terms of you getting to keep money that you've earned instead of losing it to income tax. And that gets to be in your superannuation and accumulating for your retirement, which you can then access without that tax on the other end. So you get to keep that tax savings for yourself, and that can make a significant difference over time. And it gets greater again if you're on a higher income.
Definitely. The other element that forms a part of people's superannuation is the money that your employer is contributing for you over your working lives. Now, those of you who have been in the workforce for a period of time will probably know that it started at a lot less than 9.5%. And now it's also starting to move out where it will eventually get to 12%. Currently, in this current financial year, for the next couple of days at least, you're receiving 10% in terms of your superannuation guarantee contributed from your employer. That is going to go up to 10.5% from 1 July. So you should see that bump in your contribution amounts when you're checking those, as we mentioned at the start. But just beware, it then continues to go up by 0.5% every year, every financial year, every 1 July, through until 12% when it reaches that at 1 July 2025. So that's going to make a very, very big difference, particularly for younger people as they start to join the workforce. I think this next graph, Tina, or the next table, sorry, is actually a much better picture about the potential tax savings that apply if someone chooses to salary sacrifice. And I know this example is based on someone earning $100,000 per year and contributing 5% to their superannuation. Did you want to step us through the genuine benefits that this example uses?
The great thing about this example is you can see how much your 5% in the hand is, because that's what you'll be giving up in the hand. So on the left-hand side column, we can see a take-home pay of $2,884 a fortnight. Now, if you redirect 5% of your gross income towards salary sacrifice, you're going to take home $2,757. So you're giving up $127 per fortnight. But when you get into superannuation is $66 more, meaning 5% of your gross salary per fortnight is $192 per fortnight, but you don't lose $192 in the hand. You only lose $127 in the hand. And that money is redirected into your superannuation, which is an extra $66 more. So it's basically the difference of tax that you would have lost. You get to keep. Now, if you annualize that out for a full year, it's $1,716 of tax savings, money that you would have lost, you get to keep. Do that over 10 years, it's $17,160. Now, that's not even taking into account the actual savings itself that you put in to superannuation and the compounding investment earnings over that period of time. So giving up 5% of your gross income can make a significant difference over time to your retirement nest egg. So it's really important that you start early, but even if you haven't started, any amount you put away is going to make a difference to your retirement savings, because you get to keep money that you would have lost to tax, and you're getting that compounding investment returns as well.
The government doesn't need any more of our hard-earned money. But Tina, I'm going to put you on the spot here. Again, this is another question that I get asked quite a lot. Let's say somebody in my position, for example, and let's call it 45, just a nice round figure. If I'm 45 years of age and I've got a mortgage, am I better off putting money into superannuation and salary sacrificing, or paying off my mortgage?
That's a good question, and there's more to it than just sort of a straight answer of better off. What I always help members to look at is the trade-off. If you've got a situation where at the moment interest rates are pretty low, and if you're on the 32.5% marginal tax rate, you're guaranteed tax savings is 17.5%. So it makes up for that interest expense that you've got, that you would have incurred on your home loan by not paying down it faster. So over time, when we've done the calculations, your superannuation would be expected to grow greater than what you could potentially have saved in interest expense. But having said that, the uncertainty around that is obviously interest rate could rise. And so it's very difficult when we're looking long term. We have to make some assumptions there. But most of the time, the superannuation accumulation outweighs the home loan on the assumption that the interest cost is less than the potential investment earnings, but it's also more than make up for the tax savings. The other thing that people need to take into account is if their debt level is very high, obviously they're also exposed to risk of being unable to afford the loan if, for example, they rely on a couple to be able to service a loan and one loses their job. So you've got to take that into account too, that sometimes you might have to focus on reducing debt, paying more tax on your income, reducing debt because your debt level is at a high level that could put you, at risk. But if it's at a manageable level, it may work out more effective to accumulate superannuation, with the potential view that when you get to retirement, if you still have residual debt, you could take a lump sum out of your superannuation to pay off residual debt, and the net result could be better.
Well done. Good answer. I like it. Thank you, Tina. All right, now, of course, when we're talking about superannuation guarantee paid by your employer and salary sacrificing, it's important to know that there are contribution limits. So there are caps on how much you can contribute to superannuation. Okay. Now, in the first instance, we're talking about what we call concessional contributions. So concessional contributions are anything that your employer contributes, whether that be your superannuation guarantee, any additional employer amounts that they're making. So they would be voluntary employer contributions, anything that you salary sacrifice, and any personal deductible contributions. So by personal deductible contribution, we're essentially saying that you're contributing money from an after-tax source to your superannuation fund, but then claiming a tax deduction on that. So essentially turning it from an after-tax to a salary sacrifice contribution. Concessional contribution cap is currently $27,500 per financial year, and you only pay that 15% contribution tax on that. But Tina, there is the opportunity for people to actually contribute above that contribution cap if they've got unused cap space and meet certain conditions, correct?
Correct. That is a relatively, well, it's not new anymore. It was new legislation that came in 2018 and 19, a provision which allowed people who may have not had the opportunity to put a lot of money into superannuation to catch up. And that's called the carry forward provision. So if you haven't used up your concessional caps since 2018-19 and you've got less than $500,000 in superannuation, you may have some available unused cap, which is called carry forward, and you can carry forward into a future year to use. So it is possible for you to contribute more than the annual cap if you have carry forward. Now, it's important if you are going to be making contributions above the annual cap that you check all of these provisions that you're eligible before you do so, because any breach of caps would mean extra tax,
which we do not want to pay. And a very good way to actually identify whether or not you've got any unused cap that you can carry forward is through your MyGov account. So if you go into your MyGov account and then into the ATO section, under the superannuation tab, you'll be able to identify what level of contributions you have in any given financial year. So that's the source of truth that I would absolutely recommend everybody touch base on. Non-concessional contributions are contributions that come from an after-tax source. So if you're putting money into your superannuation direct from your bank account, so to speak, or anything that that you contribute from an after-tax source is considered a non-concessional contribution. So no tax applies to any non-concessional contributions that come into the funds, but again, there are caps in terms of how much you can contribute. It is currently $110,000 per year, and assuming you're under age 67, you can also use the bring forward rule, which is using 2 additional years of $110,000 and contributing up to $330,000 in the first year. It just means that you can't put any additional amounts in for the following 2 financial years. Now, currently, and this is changing, if you are between the ages of 67 and 74, you can put in $110,000 per year as long as you meet the work test. And once you reach 75 and over, you can no longer contribute any additional non-concessional amounts to your superannuation. We are going to discuss this a little bit later, Tina, but there are some changes to the work test and people's ability to put money into superannuation as we're getting older.
It's certainly going to be a little bit simpler with regards to some of those changes that apply from the 1st of July 2022, and we'll cover that in the slides to follow.
Brilliant. Now, one of the questions that's come through was specific in relation to spousal contributions. And the question is, where somebody, one person as a part of a couple is earning more than the other. And the example being used is if someone earns $40,000 as opposed to $320,000. When can you see the spousal contribution being used, Tina? And what are the potential advantages of doing that?
So spouse contribution is still going to be measured against the non-concessional cap. So it doesn't really give you extra available cap to contribute, but where there's a little bit of an incentive when there is a low income spouse that you're putting money into, is that the government has gives you a tax rebate as an incentive. That tax rebate is 18% of $3,000. It's $540 tax rebate available to the contributing spouse. So that's the high income spouse putting money into the low income spouse's superannuation. Amounts of $3,000 will get a tax rebate for the contributing spouse of $540. You can contribute more than that, of course, up to the non-concessional cap, but the rebate is capped at $540. And it also applies based on the recipient's spouse, the spouse that's receiving the contribution, how low their income is. So once they get over the upper threshold, there's no rebate at all. So that's just a little bit an incentive. It's better than nothing. I guess it's 18% of $3,000. It's an 18% return. You could look at it that way, guaranteed in the form of a tax rebate. You can, of course, put more than that, and that will just help to equalize your superannuation ownership, which can help with maximising out any caps available in regards to how much each person can accumulate in superannuation.
Perfect. Now, I know we've got consolidation on there. That's not really a contribution per se, but it can potentially save you money in terms of duplicate fees, which would be both administration fees and potentially insurance premiums. So that's why we've put it on there, because it can add to your retirement end state. But we also touched base in terms on the family home earlier on, and what we're actually referring to, Tina, in that case is people taking advantage of the downsizer rule.
Yeah, so we know that with superannuation, government has put in caps that apply for contributions. So different contributions have a different cap applied to it. So we talked about the concessional contribution cap, which is the cap that applies for salary sacrifice, employer super guarantee payments, and personal deductible. We talked about the non-concessional cap that's coming from your after-tax contribution, but your spouse contribution is also measured against the non-concessional cap. And lastly, there's the downsizer cap. So the downsizer cap is a separate cap to those other two, and that is available where you have triggered a sale of a principal place of residence. There are other sort of rules that you need to meet, but essentially you've sold a principal place of residence and you've got funds available that you would like to contribute. You can do that under the downsizer cap, and that amount is separate to your other caps, and it's $300,000 per person, and it's only once in your lifetime that you can use that cap.
Beautiful, thank you. Now we've also got another question that's popped through. Is it too late to make a post-tax payment into superannuation for this current financial year? And the short answer is no, depending upon how you can make that contribution. Certainly, if you are in a position where you can drop a check into our office by 2 p.m. tomorrow on the 30th, that would be considered a contribution in this financial year. Or if you can visit any of our offices and make an FPOS contribution, you would also be considered having done so in this financial year if you do so by 4 p.m. tomorrow afternoon. Generally, you would be able to do it via BPay, but if you are going to attempt it via BPay, it's essentially down to whether or not we receive the funds in time by the end of the financial year. And BPay can be a little bit finicky. It can be 2 to 3 business days before it is received. So just be aware of that. If, as I say, if you can get into an office, we should be able to assist you with that contribution, but otherwise, there's a good chance you may have missed the boat. All right, so when can you access your super? This is the fun stuff, I suppose. Now, as you'd probably already know, there is a sliding scale as to when you can access your superannuation. So if you are currently 58 or 59, and you can see the dates of birth ranges that are in there for that. So if you were born between 1 July 62 and the 30th of June 1963, you can access your superannuation at 58 if you are genuinely retired. The same if you were born before the 30th of June 1964. So genuinely retired, I'll tell you, essentially means that you are never intending to return to work more than 10 hours per week. And if you meet that condition, then you would be considered retired and have met a condition of release. If you are 60 or older and you cease an employment arrangement, that also means you've met a condition of release, and you would be able to then access any of the monies in your account at that point in time. So ceasing an employment arrangement, you might be working full-time and then have a small part-time job that you've got on the side, and if you left that part-time job, for example, but kept your full-time position, you will still have met a condition of release because you've ceased an employment arrangement, and that will give you access to some of your superannuation balance. After 60 or after you've met your preservation age, you can also access your monies through what's called transition to retirement, which we'll go into in a little bit more detail as well, Tina. But I'll let you do the really fun one. Once you're age 65, what happens then?
Well, you meet a condition of release just by reaching age 65. So there isn't a requirement for you to actually cease work of any shape or form. You could continue your existing job and have met a condition of release on reaching age 65. All that really means is that you can get your hands on your superannuation in an unrestricted way if you want to. That doesn't mean you would need to, because if you're still working, you may not need to, but it just means that you've met that condition of release, and if you wish to access your superannuation, you've got unrestricted access to it.
I hope you appreciate I let you do the fun stuff, Tina. Now, there's a couple of different ways that people can access their superannuation. Of course, let's assume that you reach 65 or you're fully retired from the workforce. You can make a lump sum payment or withdrawal, from your account, and there wouldn't be any limits on that. But some people tend to choose to set up an income stream.
Certainly, I emphasize unrestricted. It just means that you can choose how you wish to take your superannuation. In terms of how you would do that, of course, is what we help members with, to figure out how they're going to set up their money to meet their ongoing living requirements for their retirement. And sometimes a lump sum is going to be part of the strategy, potentially for, say, for example, debt reduction, or it could be to pay for a lump, for a big expense that they've been planning, whether that's just home improvements or purchase of a vehicle, etc. So a lump sum could be an appropriate way to take superannuation. And the other way to take it is as an income stream. And why would that be relevant? Or most people are going to not have any wages coming in anymore, and having a regular income to be able to replicate having a wage is a way that they could have their superannuation set up. So superannuation has two phases. In this illustration for this slide shows in your first phase, that's your working life. That's what we call the accumulation phase. So in this phase, that's where you've got contributions going in, made up of what your employer's been putting in, what you've been putting in, whether that is by way of salary sacrifice or regular payments or lump sums and so forth. That goes into your accumulation account and is invested, and there's taxed in that those investment internally within the fund. When you meet a condition of release, or even if you're in transition, it is possible then to move that accumulated money to create a pension account. I call that the second phase of superannuation. So it is still under the superannuation umbrella, but now you've moved it into an account where you can start receiving regular payments in the form of a pension income, which can be set up to be paid fortnightly, monthly, quarterly, whatever frequency suits you in terms of managing your cash flow. And because you've got unrestricted access to it, you can also make lump sum withdrawals at any time. Really, it can't be any simpler than that. Having the ability to receive a regular payment in the same way that you've been accustomed to when you've been paid, without having to worry about any tax, and being able to draw a lump sum if something comes up and you need to pay for a lump of for a larger amount of money. No investment earnings tax on the investment earnings, and no income tax when you receive that income.
Nice. So we talk a little bit now about the different types of pension products, and the first one off the rank is the transition to retirement pension. Tina, what's this about, and when would people potentially use this?
So the product as a pension, which I call the second phase of superannuation, it's essentially the same in essence. But the difference with a transition pension is that you have not met a condition of release. However, you've met the preservation age. So you've met the minimum retirement age, but you're not yet retired. So you don't have unrestricted access. You have what we call a transition to retirement access. Now that allows you to be able to set up a transition to retirement pension. What does that involve? It means deliberately transferring a lump of money from your super account to open a transition to pension account. Your monies in those accounts are still going to be invested, so they work in the same way, and the fund also pays tax in the same way as an accumulation account. But where it differs is that your superannuation accumulation receives contributions, your pension can pay out a pension payment. So in the transition to retirement pension payment, there are some rules. You cannot receive a pension payment of so pension payment is limited to a maximum of 10% of your balance. That's the annual pension payment that you can withdraw and receive from your pension. And you cannot make lump sum withdrawals because, again, you haven't met the full condition of release. So it's only pension payments that you can receive. The tax implications for the pension payments are simple when you're 60 years of age or over, in that it's tax-free. If you're under 60, so if you started at age 58 or 59, the pension payment is taxable income, but there is a 15% rebate, which makes that a little bit lower than ordinary income. For most people, a transition to retirement pension isn't a necessity. Sometimes we would recommend it as part of a strategy where it could be to create more cash flow to accelerate debt reduction, or it could be to create more cash flow to allow the member to reduce the amount of work. So they may go from full-time work to part-time work, and that allows them to supplement their part-time work to be able to maintain their cost of living. And sometimes we use that transition to retirement strategy as a way to allow you to maximize your pre-tax contribution into superannuation. If you're not able to do that with your wages, then this could be a very simple and tax effective way for you to be able to do that and enhance the build-up of your superannuation. But that really mainly works when you're over 60 years of age.
Then I guess the second element of it, as you've mentioned, is an allocated pension, and that has some distinct differences between a transition to retirement and allocated pension, Tina.
That's right. The allocated pension in retirement phase, key difference is you now have met the condition of release, so you have unrestricted access to the funds, and when it is in that retirement phase, there is no investment tax. There's no tax on the investment earnings. In addition to that, your pension payment has no cap in that there's no maximum annual pension payment. You can elect a pension payment of any amount you would like. And you can also draw lump sums out. Of course, that's going to translate into potentially you drawing out the money a lot faster than it might last. So it is going to be within your control how much money is in that account and how long it would last for, based on how much pension payment you elect to withdraw and whether you make any lump sum withdrawals as well, because there's no guarantee that's going to last your lifetime.
I suppose the other element of both the transition to retirement and allocated pension, I'm not sure if I heard you mention it, Tina, is that there is a minimum amount that you must take out each year as well.
Correct. The minimum amount is a percentage based on your age, and normally it is for under 60 years of age, 4%, 60 to 70, 65, I'm getting my ages confused. So below 65, it's 4%, that's normal. And then from 65 through to 75, it's 5%. However, there's been provision in the government rules to allow people to draw less than that in the last 2 financial year and the coming one, and that was reduced by 50%. So it just means that you have the flexibility to draw less out, but you, of course, for a lot of people, they have to draw what they have to draw to meet their living expenses, and quite often that is above the minimum.
That's why my budget always suffers, I'm afraid. Now, longevity is something I know that we as an industry actually look at quite frequently, but just for those that are on our presentation today, Tina, what are we referring to here?
So we know that with superannuation, you have unrestricted access. So when you set up a pension account, you can draw any level of pension payment you want. You just have to at least draw the minimum. So for most people, because they can draw whatever they like, the money can run out faster if they draw more. And so when we're looking at longevity, we're looking at helping members to determine how much they can pull out of their pension account and still ensure that they have sufficient funds to last their lifetime. And people are living longer. So if you're retiring at 65 and you live through to 95, you've got 30 years of retirement funding. And so longevity is going to be an issue if you're not taking into account how much you're drawing out against the capital you have. So do you have enough? That's something that we can help members with when we do some financial modelling for their retirement life.
And I think I might just go quickly over a couple of these slides, just in the interest of time. I think this one, Tina, is kind of how it best describes how you as a planner in particular can help somebody in retirement make the most of the options for them to live comfortably.
Yeah, so we talked about before how much is enough for retirement, and we mentioned, you know, the $1 million figure floating around. However, in this example, we can see that it is possible to have a comfortable retirement with $600,000. So in this example, we've got a couple who are almost pension age, 65 and a half and 66 and a half. They want to have an income goal of $63,000 per annum. So they're not quite pension age at retirement. So you can see in the first year, they are fully self-funded. Represented by that purple graph, it's money that they'll have to fund themselves with their superannuation money. But in the second and third and subsequent years, there is a part age pension that funds their requirements, part of that, and then they're using their superannuation to fund the gap. So that top line is the $63,000 target. The purple is the source of funding. So the blue is the age pension, and the purple is their own superannuation money in this illustration, in the form of an allocated pension. And you can see that over time, they're getting a little bit more age pension until they get to full age pension at around, I think it's around the early 70s. And so at that time, the full age pension is funding about 60% of their target requirements, and they're funding the other 40%. But it does run out, so we see that gap later on, where if they've used up all their money, then they're fully reliant on just the age pension. But that's through to 90.
Yeah, and I suppose as well that the consideration is that we're more likely to use more money in the earlier years of retirement and slow down, for want of a better term, as we get older. And perhaps less money is required at that particular point in time.
Well, that's where we can help with tailoring the projections.
Yeah, definitely. Now, age pension is something that some people may be eligible for, and how that all works. So we're going to cover off that in a little bit more detail over these coming slides. Tina, but there is obviously some eligibility criteria that needs to be met in the first instance.
Certainly, you've got to be the eligible age and meet the residency requirements, but it's the means test which will then drive whether the rate of payment you get. So that there's an assets test and an incomes test, which will go in a little bit more detail, and that will drive your payment rate for the age pension.
Beautiful. So talking in the first instance, the eligibility on age. So again, it's somewhat of a sliding scale. Currently, you can be 66.5 years of age if you were born before the 31st of December 1956 and apply for the age pension. Anybody born after that date must be 67 years of age to be age pension eligible. Now, you mentioned in the previous slide there, Tina, that there is a means test, and I know it starts with the assets test. How much can people have as an asset before they lose pension?
So this slide illustrates the single homeowner and the single non-homeowner rates. The purple bar, if you're below that, you get full age pension. Then once you go over that, in that blue section up to where the orange comes in, you get a part age pension. And then from when the orange part cuts in is when you don't get any age pension at all. So you can see the figures are higher for a single non-homeowner than for a homeowner. And that's the recognition that a non-homeowner needs more investment capital to also generate income as they'll be paying rent. The couple rate, which is the next slide, also the same concept in terms of the sliding scale in regards to full age pension if you're under 405,000 for a couple homeowner, part age pension if you go up to 901,500, and then no pension thereafter. And again, the non-homeowner figures are higher. So the assets test essentially is adding up all your assets, anything that you have to your name, with the exception of your principal place of residence. So your home is excluded in the valuation for your assets, but everything else is included. So things like your personal effects and your car is included, but it is the second-hand value, not the new value, the second-hand value. And bank accounts, shares, it also includes balances of your superannuation and your pension accounts.
Thank you. It doesn't include the balance of a younger spouse that still remains in superannuation, Tina, is that right?
That's correct, where there is a couple and one member of the couple is age pension age, but the other member of a couple is not yet age pension age, in which case the superannuation account that belongs to the person that's not yet age pension age would not be included in the assets test for the person who is age pension.
So if I trusted my better half, I could potentially give her some of my assets.
That is a possible strategy in which we can consider in trying to maximize the eligibility, but it's only a temporary situation, because when the member that's not pension age reaches pension age, their superannuation would be coming into the assets test.
Well, I will say live that I do trust her, just in case she's listening. Now, the second element of this, Tina, is obviously the income test.
So we've got the assets test calculation, and that will determine the rate of age pension under the assets test. Then there's an incomes test, and the incomes test has a similar mechanism in that if you're below the lower threshold of income, which is $180 a fortnight for a single or $320 for a couple per fortnight, you'll be eligible for a full age pension under the incomes test. And then once you go over that, it's a part age pension. And once you reach the upper threshold, it's no age pension. So the incomes test will then determine your age pension rate. Now, between the two tests, the incomes and the assets test. It's whichever test that gives you the least rate of eligibility for the age pension will be the overriding test. So it is possible for you to be eliminated, or rather precluded from an age pension from one test while you pass the other test. So the simplest example would be if you are already pension age, but you're still working full time, even if you don't have much in the form of assets, and you would qualify for a full age pension under the assets test, you might be precluded under the income test because your salary is above the upper threshold. And therefore, you would not be eligible for any part age pension yet while you're still working. On the other extreme, you may be asset rich but income poor. So you could have maybe a second property or a block of land that precludes you under the assets test, yet under the income test you qualify.
Beautiful. So let's assume then that someone is eligible for the full age pension. You can see here on our screen that we've actually got the pension rates as they currently stand. So if you're a single person and eligible for the full age pension, you're entitled to the 25,677. If you are a couple, it's 38,708,000 or 19,354 each for a financial year. And certainly if you're a couple apart due to ill health, so one of you might be in hospital or in an aged care home, for example, unfortunately you're not entitled to the couple rate. It's 25,677 each per year, which is still the single rate. So just be aware of those. That's what you would be fully entitled to should you get the full age pension. Tina, a lot of people I know are after the age pension on the basis of getting the healthcare card. This one's slightly different though, the Commonwealth Seniors card.
The Commonwealth Seniors healthcare card are for people who are self-funded retirees. So they're people who have not been eligible for an age pension due to either assets or incomes test. The Commonwealth Seniors Healthcare Card allows them to potentially have access to cheaper pharmaceutical, but it is income tested, but the income test limit is higher than the age pension income test limit. So you can see here for a single, it's $57,761 per annum. That's the cutoff rate. And for a couple, it's $92,416. So if your income is below that, but for whatever reason, you're not eligible for an part age pension or an age pension, then it is quite possible for you to be able to get the Commonwealth Seniors Healthcare Card.
Beautiful. And obviously that does give you some access to cheaper medicines, bulk bill doctors. They're not getting any cheaper, unfortunately. But I also know that it may, in different territories, states or government or local areas, you may also be entitled to lower rates and bills or discounts on public transport if that's your chosen method of transport. So just be aware of that. So you may not be entitled to the age pension, but it's worthwhile just investigating what you might be entitled to just in case. Now, there are some changes coming up from 1 July. So from this Friday, there are some changes. Tina mentioned when we were talking about an allocated pension and the fact that you did have to take a minimum amount out each year, starting at 4% up until age 65. Just be aware that the government has extended that 50% reduction on the minimum drawdowns for another financial year, so through until the end of June 2023. So if you're on a pension already, just make sure that still meets your needs. I think a win for those people that are on lower incomes. Previously, you had to earn $450 a month before you were entitled to a superannuation guarantee payment. That threshold has been removed, so you'll start earning superannuation on your very first dollar, which I think is a very positive outcome. And of course, we also mentioned that superannuation guarantee, the rate will be increasing to 10.5% from 1 July. So I encourage everybody just to make sure and get excited and see what that means to them. The other part where the government has actually made it simpler to make contributions to your account as we've gotten older Previously, if you were 65 or over, you would have to meet the work test to be able to make a voluntary contribution to your super. But Tina, you no longer need to meet the work test, and there's also some positive news in terms of the bring forward rule.
It makes the rules a little bit easier in that you can use the bring forward rule up to age 75, and you can essentially contribute to superannuation up to age 75. So regardless of whether you are working or retired, you can make contribution to superannuation for quite a while. Of course, the caps need to be taken into account, but you don't need to have any eligibility work test rules that need to be met anymore.
Which is brilliant. The other aspect of it, when we talked about the downsizer in some detail, from 1 July, the good news is that you can be 60 years of age, and providing you meet the other criteria, you could potentially utilise the downsizer provisions as a part of your retirement strategy as well. So previously you had to be 65 years of age. And we won't go into detail on the first home buyer scheme, but that's something that's available to people as well. Another important part of our retirement planning is certainly estate planning. Unfortunately, we're not going to live forever, and you know there could in fact be some quality of life issues. So we're talking about, first and foremost, making sure that you've nominated a beneficiary within your superannuation. Let your superannuation fund know where you would like the funds to go to in the event of your passing, and you've got a couple of options there. But if you do not have a nomination, I can tell you that it is the superannuation trustee that will make that decision for you based on legislative guidelines. So just be aware and investigate what you have in place for yourselves at the moment, and take advantage of that. Tina, in terms of a will and a power of attorney, that can also contribute to the overall plan, and certainly in the lead up to passing away.
Well, any financial advice that we help members with, we also look beyond their lifetime and ensure that they've got instructions in place and strategies in place to ensure that their assets pass on to the right beneficiary in the most tax effective way. So you mentioned before making a nomination of beneficiary on superannuation. Then there's other assets that are outside of superannuation, like the properties, shares, and so forth. So you need to have a valid will to ensure that whomever you would like your assets to flow onto is clearly stated. And the power of attorney is making sure that you appoint someone who you trust to make financial decisions for you if you become incapable of doing so. Now, that may not happen for quite a while, but accidents and unexpected events can result in loss of capacity. And if you have not appointed a power of attorney at that time, then you may have lost the capacity and the ability to actually appoint a power of attorney.
Yeah, everyone's got a mother, I think, that suggested they wear clean underwear when they leave the house. Now we're going into a little bit more information, I suppose, about where you can get further assistance should you need it. And I know one of the things that our financial planning team can help with, Tina, is aged care, which is wonderfully complicated.
Certainly is, and it hasn't been an area that we've done a lot of work on, primarily because a lot of people don't think that far ahead, and it is something that is not very pleasant to think about. But it may be that you're not thinking about aged care for yourself, but you could be power of attorney for your aging parents, and maybe in a position where you have to make decisions for them about aged care. So we can help with that. And where the complexity is really is the cost of funding and also the ongoing cost of living there, plus the social security implications that can be impacted in regards to age pension and how the cost of aged care is calculated based on your means. So all of that makes it very difficult, in that you've already got a difficult situation having to make these decisions, but then you've got to consider the financial consequences as well. So we try to help in regards to, I guess, looking at the financial options and understanding what the implications are to help with that decision making.
Peace of mind, essentially. Now, I promise we are kind of wrapping up now, so I'm going to start sharing with you how you can get some further assistance should you need it. I do know we've gone slightly over time. I do want to make sure that we do answer some questions for you. I know we've got one there in particular to get through, so we should only be another 5 or so minutes, and then we'll be able to let you go. I appreciate you staying with us. So if you need some further help, if you have some more questions, if you've already asked a question, as I mentioned at the start, someone from our relationship management team will actually reach out within the next couple of days and make sure you've got all that you need. And they can help you with some general information. So if you were to contact our contact centre, they can help you to answer any questions in terms of superannuation legislation, filling in forms. If you've got any questions in regards to your account, they'll be able to assist you in that way as well. So please, by all means, reach out to your local RM if you don't need to right now. They're always available for you. As a part of your membership, so at no additional cost, if you need some advice on some single topic discussions, so for example, if you want to make sure that your superannuation contribution strategy is all it can be, or you need to chat to us about your insurance or your investment strategy as standalone topics, then you can access what's called our limited advice. So we would set you up with an appointment, you'd have a conversation with a qualified financial planner over the phone, and they would be able to help you with any of those topics and provide you with some written advice and guidance on the way forward. The ultimate, though, would be to come along and have a chat to someone like Tina. And Tina, you can cover all things financial, essentially, can't you? It's not just about your superannuation. You can look at the broader picture for not just an individual, but couples as well.
Certainly, we are looking at financial planning, so that would encompass all the areas that are relevant with regards to your situation. And that could start from a simple working out of budgeting and determining what your income needs are today, and also what you want to target for future in retirement, and then strategies around how you get there. And that would be reviewing your existing investments, which could include superannuation or non-superannuation investments. And it could also be looking at, if you're eligible for an age pension or any other benefits, how that all fits in together. Lastly, we take into account, as I mentioned, estate planning. So even though it is predominantly focused around superannuation, there are some estate planning implications with superannuation. So we take that into account when we're providing advice. And this is probably not so much relevant for someone who's close to retirement, but certainly for younger members if they need some advice around insurance.
Perfect. I'm going to give a shout out to our financial advisors as well. I mentioned at the start that we're salaried staff members. They don't get a commission or bonus regardless of the advice that they give. But more importantly than that, I know our financial advisors, and I've seen them work hard, and they do that to make sure that they put our members in a better position. So if advice is something that you think that you need or that you are considering, I would highly recommend you reaching out and having a chat to one of them. They're a fantastic bunch and they do a very, very good job. Now, if we go back to the very, very start of the presentation, I mentioned that it's important to understand where we are in the here and now. And a great way that you can actually do that is going on to our member portal. So if you haven't already logged in and you haven't seen our member portal, it's pretty cool now and nice and modern. You might not know that there's a lot of stuff that you can do on there now. So if you need to make a contribution, you can see the different options that you have available to you. You can obviously check your account balance. You can view what investment options you have, but also the investment earnings that your account is currently generating. Your insurances information is also on there. And if you need to make any changes to your account, like a non-binding beneficiary nomination, if you need to change your investment option, you need to increase, decrease, or cancel your insurances, you can essentially do that through the online portal as well. Anybody that's eligible to make a withdrawal from your account, in good news, if you want to make a withdrawal of up to $20,000 per day, you can actually do that through our portal as well. And anybody that's receiving a pension and need to make a change to their pension payment amounts, you can actually do that online as well. So it's actually a very cool spot to begin your investigations and answer any questions that you might have for your perfect circumstances at the moment, and then lead on from there. There's a few things that we'd love for you to do right now. Log into the member portal. Okay, that's a great starting point. If you are seeing any of your local RM, whether or not you make an appointment to have a chat to them in the office, if you have a chat to them over the phone, or if you see them out and about in schools or workplaces, please by all means come on up and have a chat. We can answer most of your questions, but we can also identify whether or not having a chat to one of the financial advice team, whether it be limited advice or someone like Tina, and be able to provide you some direction to get in touch with them and help you kind of get to where you wanted and needed to be. Our contact information, should you wish to reach out to us, if you'd like to have a chat with our contact centre, 1300 658 776, or send an email to our fund office at catholicsuper.com.au. They're a good team there and they'll be able to answer a lot of your questions as well. So please make sure that you do reach out and let us help you. Now, to go through some questions, I've got one question which is a secondary question. If you've got a higher income spouse, Tina, and they make a large contribution, whether it's concessional or non-concessional, to their partner's super, does that decrease the higher income earner's taxable income? And let's use 20,000 as an example.
Unfortunately, a simple answer is no, because your taxable income is only reduced when you make a personal tax deductible or salary sacrifice contribution to your own fund. It doesn't apply when you're making a spouse contribution. So essentially a spouse contribution is an after-tax income.
Yep.
I mean, an after-tax contribution, I should say.
And essentially the only benefit you can get from that is on the first $3,000 if your partner meets the conditions, and
yep,
you would get a $540 tax rebate.
Yeah, and that rebate you can say is like a credit. So that gets deducted off your tax liability. So it doesn't reduce your taxable income, no.
But we will say your partner would be very happy with you.
That's right.
So there's definitely a secondary benefit. That is all the questions that we've had. If anybody's got any others that they'd like to shoot through in the here and now, that we can answer those for you. Otherwise, you will receive a survey, and on that survey, you can request someone else to reach out to you and assist you with any additional questions. As I say, one of the RMs would reach out and answer that question for you. But without any other questions coming through, if I could just say thank you so much to Tina for presenting with me today. Thank you for Justin, who's been in the background making sure that things are running smoothly, and obviously thank you to each and every one of you that's come along on probably your holidays and given up your hard-earned time to come and stay with us for this presentation. We hope you enjoy the rest of your break, the rest of the school year, and we look forward to seeing you again at a future event.
Thank you, and have a good afternoon.